Welcome, everyone. I am absolutely thrilled to have you here for this explainer. If you've ever looked at a massive, globally recognized corporation and wondered exactly how Wall Street manages to slap a multi-billion-dollar price tag on it, well, you're in the exact right place. Today, we're going to demystify how we actually value giant companies. We'll be doing a deep dive into the absolute bedrock of corporate valuation, exploring two very different yet equally fascinating paths to reach the exact same financial summit. Okay, let's dive into this. It all starts with this massive, foundational question. How do you put a price tag on an entire company? I mean, it sounds incredibly complex, and yeah, the math can definitely get deep, but the core concept is actually quite intuitive. Think of a business like a giant pie. Before we can figure out what one individual slice is worth to a specific shareholder, we've got to figure out the value of the whole pie before it even gets sliced up. So here's our roadmap for today's explainer. 1. Valuing the entire firm. 2. Free cash flow to firm. 3. The cost of capital path. 4. Adjusted present value, or APV. And 5. Comparing the two paths. Let's jump right into Section 1, Valuing the entire firm, the anatomy of a business. When we set out to value an entire firm, we're looking at the company as a whole, breathing entity. And this brings us right back to our pie metaphor. The value of the firm simply equals the value of its debt plus the value of its equity. You see, most companies are funded by a mix of lenders, like the bondholders and banks who hold the debt, and the owners who hold the equity. To get the true total value of the firm's operations, we absolutely cannot just look at the stock price. We have to combine both the debt and the equity. We really have to value the entire pie. Moving right along to Section 2, Free cash flow to firm, the golden metric.
To value that whole pie, we need to know exactly what kind of cash it's generating, right? So the absolutely crucial point here is this definition: free cash flow to the firm, or FCFF. It's essentially the sum of cash flows to all claim holders prior to any debt payments, but after taxes and reinvestment needs. I want you to think of FCFF as the answer to a very specific hypothetical question. What would this company's cash flow be if it had absolutely zero debt? We calculated before interest payments because we're looking at the cash generated by the business operations themselves, regardless of how the business is actually financed.
Now, you might be wondering how FCFF stacks up against other metrics you hear thrown around on the financial news. Well, while FCFF finds the firm's total operating value, FCFE, free cash flow to equity, subtracts all those debt payments to figure out what's left purely for the shareholders. And then there's EBITDA, which is pre-tax and totally ignores the money a company has to reinvest just to keep the lights on. That's why, when we want to value the whole mountain, FCFF is absolutely our preferred gear. It accounts for taxes and capital expenditures, making it a way more precise tool for long-term valuation than EBITDA. All right, Section 3, the cost of capital path, the bundled package. Now that we have our golden metric, let's start the climb up our first path. In the cost of capital approach, we find the value of the firm by taking those expected free cash flows to the firm we just talked about, and we discount them back to today's dollars using the weighted average cost of capital, or WAC. You can think of WAC as a bundled package. The massive tax benefits that a company gets from having debt, alongside the risks and potential bankruptcy costs associated with that very same debt, well, they're all baked right into the single discount rate. And the math behind this is actually really elegant. We're summing up all those future free cash flows to the firm and dividing them by 1 plus the WAC, compounded over time. By adjusting that denominator, the WAC, to reflect the cost of both equity and after-tax debt, we seamlessly turn future operating cash flows into present-day firm value. It's a really powerful shortcut. But as smooth as that sounds, there is a totally fascinating quirk to this path. To find the true WAC, you're supposed to use the current market values of the company's debt and equity to weight the average. But wait, aren't we using WAC to figure out the value of the firm in the first place? Yep, you need the cost of capital to estimate the value, but you need the value to estimate the cost of capital. It is literal textbook circular reasoning. You literally need the answer to find the answer. Analysts usually solve this dizzying loop by calculating back and forth until the numbers magically converge. But it's a brilliant reminder that Wall Street valuation is definitely as much an art as it is a science. Let's pivot to Section 4, Adjusted Present Value, or APV, the itemized receipt. If the cost of capital approach is a bundle package, our alternative path, APV, is the highly detailed itemized receipt. Instead of hiding the effects of debt inside a single discount rate, APV drags them out into the light in three very distinct steps. Step 1, we pretend the firm has absolutely no debt, like it's entirely equity funded, and we value it just like that. Step 2, we acknowledge that debt actually creates a massive tax shield, so we calculate the present value of those tax savings and add it to the firm's value. Step 3, we recognize that debt also adds serious risk, so we calculate the expected cost of bankruptcy and subtract it. Putting that into an equation, it is incredibly transparent. Current firm value simply equals the value of the unlevered firm plus the present value of tax benefits minus the expected bankruptcy cost. It mathematically strips out the specific perks and penalties of borrowing money so you can see exactly what's going on under the hood. Okay, let's step out of the textbook for a second for a massive real-world reality check. $2.7 billion. That $2.7 billion is exactly what private equity firms pay to acquire the retailer J.Crew in a leveraged buyout, or LBO. And get this, they funded it with a staggering $1.85 billion in debt at a 7% pre-tax cost. When analysts look at a highly leveraged deal exactly like this one, APV is absolutely the perfect tool. Why? Because you can value J.Crew's core retail operations completely separately from all that aggressive financial engineering. By isolating the exact dollar value of the tax shields from that $1.85 billion in debt and weighing it against the severe bankruptcy risk, the APV method reveals whether the buyers actually acquired a good retail business or if they just wildly overpaid and relied on debt mechanics to make the math work out.
All right, our final stop, Section 5, comparing the two paths, cost of capital versus APV.
Both of these paths are trying to reach the exact same destination. So how do you choose? Well, it's not just about which math you prefer. It really comes down to the reality of the company's borrowing habits. The cost of capital approach is fantastic for ongoing, stable firms that maintain a steady proportion of debt. If a company targets a permanent 30% debt ratio, WACC is absolutely your best friend. But as we just saw with J.Crew, if a company is going through massive contortions in its leverage, like taking on huge new loans or rapidly paying off debt, the APV approach is far superior. APV handles changing leverage beautifully because it looks at specific dollar amounts of debt rather than just static ratios. But here is the truly incredible thing. Both paths can actually be used to find a company's optimal financing mix. Take Disney's leverage, for example. Analysts calculated Disney's firm value at various debt ratios, from 0% all the way up to 90%. As debt goes up, those tax benefits increase, but so do the expected bankruptcy costs. By running the numbers, analysts found that the firm value is actually maximized right around a 40 to 50% debt ratio. That is the sweet spot where the tax advantages of debt perfectly offset the rising risks of default, maximizing the size of the overall pie. Which leaves us with a pretty provocative question. If borrowing money creates tax benefits that directly increase the value of a firm, why don't companies just go ahead and fund themselves with 100% debt? Well, because in corporate valuation, there is absolutely no such thing as a free lunch. As leverage climbs to the extremes, the very real mathematical threat of bankruptcy destroys firm value way faster than any tax shield can build it. Balancing that risk and reward, that is the true art of valuing the firm. Thanks for joining me on this deep dive, and I'll catch you in the next one.